Hello, everyone. I'm John Kogan, the CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to today's webinar entitled FP&A, Innovations in Financial Analytics to Support Organic Growth and Business Strategies. Despite recent advances in cloud computing and related technologies, many organizations are still far from where they want and need to be in terms of leveraging data to drive performance improvements. Companies largely still apply intuition rather than hard data when making strategic and operational decisions. Even when companies define performance metrics, many define vanity as opposed to actionable metrics. Today, we will discover new ways to leverage your data to drive shareholder value and competitive advantage. And we're very happy to have you all with us here today. A quick note for those who are new to Proformative. Proformative is the largest and fastest growing online resource for senior level corporate finance, treasury, and accounting professionals. We're a very unique resource. I like to say that we have no fun here at Proformative. It's all about work. People sharing knowledge primarily online. It's truly amazing network. We touched almost 750,000 folks last year visiting our site, and that's a lot of finance, accounting, and related professionals coming to learn and talk to one another online. So we welcome you. Note that all of Proformative Online is completely noise-free. There's no ads, no selling or self-promotion in the community areas of the site. We like to keep it that way. Feel free to check it out at Proformative.com if you have not already. A few notes on today's event before we get going. First off, a link to today's presentation and a link to the recording of this webinar will be sent out to all attendees within 24 hours of the event. Now, the presentation itself is already posted at Proformative.com/resources. I believe it's right at the top of the list there, as we just uploaded it this morning. So if you want to print it out, follow along, make notes, etc., or certainly share it, feel free to do so. You can download that for free at any time. We do offer CPE credits for today's webinar. If you are interested in receiving the CPE credits, first off, hopefully you signed up and requested CPE credits during the sign-up process. Secondly, you will need to answer all of the polling questions during today's event. We have 3 polling questions. They are statistical in nature, and we would appreciate, whether you're here for CPE credits or not, getting your answer. We'd like to get your insights into these questions, but if you're here for CPE credits, you really need to answer all 3 of these questions. Speaking of questions, we'd like to encourage you to ask questions on today's topic. So the way this will lay out is that today's presenter, who I will introduce in a moment, will run through his presentation. That will take us until about 1:15 or 10 of, and then we'll spend the remainder of our time in the Q&A. So we encourage you to ask questions at any time during today's presentation, and then we'll do our best to get to those questions during the Q&A session at the end of today's webinar. Finally, when we shut down the webinar, you will be asked to take a short survey. We would greatly appreciate your spending 60 seconds, that's all it takes, to tell us how we did. We always want to know what we did well, what we didn't do well, so we can do better the next time. We appreciate your giving us that extra minute at the very end to give us that quick feedback. Also, during that survey, if you'd like to be connected to today's speaker for follow-up questions or directly with today's sponsor, then we'd be more than happy to help make that connection. Speaking of which, we would like to thank our sponsor, Profix, whose commitment to thought leadership in this realm helps us make this webinar possible and delivered at no cost to the participants. So thank you very much to Profix for helping us make this happen today. We have a few learning objectives today. This is also part of the CPE process. We'd like to help you discover how to apply the lean analytics cycle, which will be discussed in today's webinar. We'd like you to learn the difference between what we call vanity and actionable metrics, which will become clear, and also provide practical examples of how actionable metrics can be used to drive change in an enterprise. So we've got a fantastic program for you today. We're really looking forward to learning all about this subject, and helping us do that today is our speaker, James Myers, Global Finance Executive and Consultant for FP&A Strategy Consulting. James has over 15 years of finance experience in high-tech and telecom industries, with time at both Dell and Nokia. He has lived and worked in the U.S., Europe, and the Middle East. Most recently, James has been consulting at FP&A Strategy Consulting, LLC, based in Palo Alto, California, where, working closely with his clients, he has successfully implemented processes and procedures focused on growing shareholder value. In his spare time, he is part of the lean startup movement in Silicon Valley and is the co-founder of Mobile Cart, LLC. James is also a certified chartered accountant. So James goes way back in the world of finance and accounting. And James, we're so happy to have you here today. Thanks for joining us.
Thanks, John, and thanks very much for the introduction. And I just wanted to also thank Proformative and Profix for inviting me back here today. And really a big thanks to everybody out there who has joined the webinar. I hope you enjoy this material. The webinar is a continuation from my last webinar that I held with Proformative that was really focused on actionable and vanity metrics. But I hope to spend a bit more time on introducing the concepts behind lean analytics, and also a bit more time applying the principles of actionable metrics. The webinar I've broken into 3 parts. The first part covers the changing landscape of FP&A. The second part covers the theory of lean analytics. And the final part covers an example of how to apply lean analytics. So, going to the landscape in FP&A. This is an infographic I found from entrepreneur.com, and it sums up the landscape we're seeing in the market today. The next time we are looking for a traditional job, what we're seeing is this move away from this traditional full-time employment to companies looking at consultants, freelancers, and contractors, filling the spaces. The advantage is there's no benefits. Little to no supervision is required as you're getting experts, and it's a pay-as-you-go system, so you only pay for what you want. The next is specialized jobs are being outsourced. Software developers, for example, this is a typical one, where software developers are being outsourced to India, Russia, and China. A software developer in India is 8 times cheaper than that in the US. When we're looking at more manual sort of labor, we're seeing jobs being outsourced to machines, and it's great they've got a picture of R2-D2 there, but you know, there's a lot of different ways we think of machines. I mean, 5 years ago, 10 years ago, we thought of tellers, but now we have ATM machines. A lot more roles are being outsourced to machines. The typical roles that I looked at a list of the top 10 roles in the future that will be outsourced, and some of the examples were very interesting. Pharmacists, for example, delivering drugs on a prescription. Lawyers and paralegals, a computer can assess and advise a client a lot cheaper than a lawyer can. Astronauts, I think that one was obvious. Store clerks, something similar to the ATM solutions. Soldiers, babysitters. In Japan, they have stores that offer babysitting services that are conducted by robots, rescuers, and even sports writers. So baseball coverage is covered today by in an automated fashion.
James, thanks for completely depressing us.
No, it's getting better. This is the good part.
Oh, okay, good.
Right. So companies are looking for internal growth, and they're looking for their own employees. So there's this move from you know, outsourcing ideas to really getting them in companies. So there's what we're finding is entrepreneurship. A good example of that is Google, that are encouraging engineers to spend 20% of their time working on things that is company related but interest them personally. Some of the results that we're seeing from entrepreneurs in companies like Google are Gmail, Google News, AdSense, and Google, even the Google shuttle bus was started by entrepreneurs. And what's happening is they're forming these what's called grouplets, where people are getting together and creating value. Okay. There's also this move away from specialists to generalists. You can see there that a specialist spending 10 years in a subject compared to a generalist that's spent 2 years, there's probably about a 5% difference. This theory came from Tim Ferriss, where he basically said he applied the 80-20 rule. I think most people are familiar with the 80-20 rule to skills, meaning that to get 80% of the way proficient in a skill, you need probably 20% of the time. It's that last 20% takes you 80% of the time. He did an experiment where he compared, and he found that there was a 5% comparative difference in a generalist who studies Japanese systematically for 2 years versus a specialist that studies it for 10 years. So in smaller companies, we're finding the value is moving more to the generalist who can do more things than a specialist. So the answer to all of this is to become an entrepreneur. This doesn't mean leave your job and join the startup world. But what it does mean is it means that people need to start thinking like entrepreneurs. Most of the theory I'm going to go through today has its roots set up in the startup world. These are part of the management techniques that startups are using, and it's really based around the high uncertainty that we're seeing in startups. But as we're seeing, and what we went through in the last webinar, is that there's an increase in the amount of uncertainty in companies. So hopefully I'll be able to share some of the tools that I've been working on with some startups, and I've also applied to mid-sized and large corporates. So the moral of this is to start thinking like an entrepreneur, whether you're working in a startup or a Fortune 500 company. Go out and create value, take risks, make life better, and be ambitious. So if you think it doesn't affect the changing landscape, it doesn't always affect FP&A and finance, have a look at the study that was done by Andrew Deichler on Google. So Google, instead of hiring traditional finance professionals when it was in 2008 and 2009, when it was trying to expand its finance team, hired engineers and business intelligence professionals to build their own solutions to free up finance resources. Google was able to reduce the finance workforce, yet still being able to maintain productivity. And they did this in 3 ways. The first was elimination. They reduced superfluous activities. And one example of this was during their close process. They eliminated some of the steps they used in the close process and reduced the amount of time from 2 weeks to 4 days. The other one was stop producing reports and wait for the questions to come in. Then they knew that their finance people could focus on real issues. The other area of improvement was around automation, and a lot of companies like Profix, they are experts in this, but they were able to automate their forecasting, reporting, headcount, and functional support reporting, putting the data into cubes and creating easy reports. And the last area is around simplification, having all the information in one place. They were able to create a web-based portal where users could come and slice and dice information and use it to their needs. So not everybody has the resources of Google and able to create their own solutions around finance. So what we'll try and do in the next 14 minutes is go through some of the more practical, easy ways to apply this without spending a lot of money. So this is really to give you just an overview of the finance function as I see it. It's broken into the building blocks of historic reporting and future prediction. These are the areas where there's a lot of ability to automate, simplify, and eliminate. What we're seeing is that once we're able to build a great foundation of historic reporting and future predictability, we're able then to move up a level into that strategic alignment. And that's where I'm going to spend most of my time today, talking about lean analytics. Another interesting piece of information that I've come across recently in the FP&A landscape is just the importance of analytics and how it plays a role in the CFO function. CFOs are moving away from the traditional functions that we're seeing, such as reporting, treasury, tax, and investor relations, and moving into the more strategic analytical direction. And you can see some of the examples. I'm not going to go into a huge amount of detail, but this is mainly focused in technology companies. But as you kind of dig into it, any company where we're seeing, and all companies are seeing, this massive increase in data, aligning with a level of uncertainty, analytics is becoming a more important part of everyday business in a finance team. So this is the way I kind of see the landscape at the moment. A finance professional is sitting in the middle of, and actually in a great position at the moment. They're sitting between the business intelligence people, the big data guys that are driving huge amounts of intelligence from huge amounts of data. But it's not about big data, it's about big insight. But how do you convert that big data into big insight? You're also interacting with sales teams, so you build, pulling some of that insight and being able to extrapolate that into the sales teams and being able to drive value and actually getting value back from the sales teams as well as incorporating it as part of the business strategy as well. So I see that the FP&A function at the moment is in a great position to really help drive businesses forward. They're in a great position. They sit between all of this information, and they're able to provide value. So my vision from the last webinar hasn't changed much. The data, we're seeing an increase in data. We're seeing an increase in uncertainty, and companies are becoming more and more dependent on FP&A for direction and analytics. And this will play an even greater role in the future, both in short-term and long-term decisions. At this point, I'd like to hand back to John for our first polling question.
Okay, so this is the first of 3 polling questions that I will launch. Once again, required for folks who are here for CPE credit. But even if you're not, go ahead and give us an answer. We love looking at these statistics. If we have time, we'll share the responses here and ask James to talk about the results. So we'll leave this open for about 30 seconds. Also remind folks you can ask questions at any time in the question box in your GoToWebinar control panel. So feel free to do that any time, and we just monitor those as they come in. And we'll queue them up for our Q&A session, which will come after the end of the slide deck here. All right, we're going to leave it open for another 5 seconds, and then we'll go ahead and close it down now. Close. And James, back to you, please.
So in part 2 of the webinar, I'd like to cover some of the theory. First, let's start with the title slide, or the title of this presentation. So the title is about innovations in financial analytics to support organic growth and business strategies. And I think, before we can begin doing that, we really need to define what business strategies and organic growth are. So here very quickly are what my understanding of business strategies, what to provide, to whom, on what competitive basis. And organic growth is really about R&D funding, geographic expansion, and product and service expansion. So in my prior life, I was responsible for the go-to-market finance team, responsible for really predicting the success of new products. That falls very much in this organic growth area about new product expansion. And what I learned at a very early stage is that traditional finance does not have any tools for measuring the success of products. But based on historic trends, we can either, products will either be highly successful, mildly successful, or complete failures. But you only know exactly what type of product that you've just launched 6 weeks into the launch, because you've got data to be able to predict that. And by then, it's probably too late to make any changes. So if it's a product that you've launched and it's a failure, you're already 6 weeks into the product launch before you really understand whether it's going to be a success or failure. Then I came across a book by Eric Ries called The Lean Startup, and there's in the book there's a lot of information about launching products and being successful. But one of the things that interested me a lot was just Eric Ries's definition of what a startup is. I just added that at the bottom. soon as it appears. So a startup is a human institution designed to deliver a new product or service under conditions of extreme uncertainty. And when I look back at my time in my role as the go-to-market finance director, I realized that even though I was working for a $40 billion organization, that is a human institution. We were, the organization was designed to deliver new products. We delivered a lot of new products over the period of time that I was there, and the conditions, in conditions of extreme uncertainty. I mean, we never knew whether a product was going to be successful or it wasn't going to be successful. So effectively, I was, even though it was a $40 billion company, I was working for a startup. So, a lot of the thinking that's coming out of the startup world is, the question is it applicable to large corporations? And what I'm finding as I'm going through this and, presenting this webinar and working with customers both small and large, is that the answer is yes. A lot of the theory is applicable. So this is just a slide from a previous session that we went through, and this is just again to kind of remind you, or kind of keep, the understanding of why I came up with the title of the webinar that we have today. And I think we're seeing that executive teams, one of the things that they're really struggling with, two of the things that they're struggling with are these business strategies and organic growth. And most of the reason behind that is around uncertainty, and really trying to understand as companies go through even more uncertainty, how it is we can add value. So as I mentioned, Lean Startup is a potential solution to this, these questions. Lean Startup is a management process designed to build and sustain a sustainable business in the least amount of time, using the least amount of resources, to deliver products and services under conditions of extreme uncertainty. Now, this is a huge topic. I can probably spend the next 3 days talking about it. But what I really wanted to focus on is not so much on Lean Startup as the processes in Lean Startup, but a very small part of Lean Startup called Lean Analytics. This is the finance side of Lean Startup. And in the remainder of the webinar, I will cover tools that can be used in both small companies as well as large corporations, mainly focused on techniques to make smarter business decisions with reduced resources during a time of high uncertainty. Now, it's interesting because going into a lot of companies and there's a lot of myths about Lean Startup, so I wanted to clear up some of those myths before we get started. And I think, I went into a company recently, and when I mentioned Lean Startup, the first thing that the person said to me was, well, that's what our engineers do, and it's their excuse for producing a cheap, low-quality product. And I think this is a bit of a myth. The idea of Lean is not about cost; it's about speed. It's using the principles. Companies waste less time because it's a disciplined approach. The second one is about it's only for startups. This we've seen isn't true, and from my experience, I can attest to this. I've applied these concepts in both small and large companies. One of the other things when I went into companies, they said, yeah, that's agile, same thing as agile. Agile is a software development methodology using iterations. Lean is a management methodology focused on building a sustainable business. It does go through iterations, so it is that, but it's more about how you get to that, not necessarily the actual programming. And the Lean Startup replaces vision. Lean Startup is just one of the many tools that we can help to realize vision, so it doesn't replace it. You have to have the vision, and you have to have the foresight to be able to be successful. So one of the other areas I would just like to cover as well is just too far is vanity and actionable metrics. So what are vanity metrics and what are the alternatives? A vanity metric is really a metric that gives the rosiest picture possible. What I find when I go into a lot of companies is a lot of management metrics are actually vanity metrics. And I guess, a really good example of a vanity metric is when you're sitting in a room with, a cross-functional team. It's a salesperson, then a marketing person, an operations person, and you put a graph up on, something similar to the one that you see on the right there, and you see that, it's this continuous trend going upwards. Then, the salesperson will claim that it's all because of the sales team. The marketing will talk about the brand and how, what a great job they're doing. And the operations team will talk about, customer satisfaction and all the great things that they're doing. As soon as we see that dip down, marketing will say, well, the brand is not where it needs to be, so it's difficult for me to sell. The branding team say, sales aren't selling very much, so we haven't got the marketing resources to do the branding. And the operations team will also, say that we're not getting enough sales to get the satisfaction levels up. So that, there's no real, no real understanding of the drivers of those metrics. So this example of a actionable metric is just sessions. So this comes from one of the businesses I advise, and it just shows the number of sessions over time and how they're increasing, and what a wonderful picture it looks like. An actionable metric is a metric that is leads to informed business decisions and subsequent actions. So there's a lot more detail. They tend to be a lot more granular. They don't necessarily have to be, but they tend to be. And in this example, I'm using dollars per session. So how, what is this app that these numbers came from? It's a shopping app. So how many people, how many sessions? So every person that comes on the session is a person using the app once. How many dollars that person sells. So in June it was 71 cents, and we can see it's steadily been declining, and really need to kind of understand that. So that's pretty, there is some actions that need to happen because that's not a great trend. Okay, before we get into the practical side of things, I just wanted to, and I think this is probably the first time this has been attempted on a webinar. This is the ice cube thought experiment. This experiment, I first read about this experiment in a book called The Black Swan by Nassim Taleb, which he borrowed from Aaron Brown and Paul Wilmot. This experiment has two parts. So the first part of the experiment is to imagine an ice cube. Okay, and in this case it's relatively simple because if you're looking at the screen you'll see the ice cube. Okay, now imagine it. How it will melt over the next 2 hours. So what you need to do is you need to imagine this ice cube melting and trying to envisage the shape of the resulting puddle. I'll give everybody a few seconds to imagine the ice cube. All right, now for the second part of the experiment. Now, consider you come across a puddle of water on the floor. Now try and reconstruct in your mind's eye the shape of the ice cube, bearing in mind that the water may not have necessarily come from an ice cube. So the second operation, I think, is much harder. The difference in the second operation resides from the following. If you have the right model and some time on your hands and nothing better to do, you can predict with great precision how the cube of ice will melt. This is a specific engineering problem devoid of complexity. However, from a pool of water, you can build an infinite possible ice cubes, if there was actually an ice cube at all. So you have infinite amount of scenarios of where that pool of water came from. The first direction on the ice cube to the puddle or pool is a forward process. The second is a backward process, and the backward process is much, much more complicated. The first is more based on physics and engineering, and you can build a model and to support that. The second is that the backward process is non-repeatable and non-experimental historical approach. So the question that this raises is why in FP&A do we spend so much time looking backwards to try and figure out uncertainty, then trying to look forwards and using on a scientific experimental basis? With that thought, I'd like to hand you back over to John with the next polling question. Thanks, John.
Yep. Okay, so this is polling question number 2 coming up right now. Like the last one, we'll leave it out for about 30 seconds. I will remind folks that at the very tail end of today's webinar, we will present you with a survey. This is after I actually shut down the webinar. And at that point, we'll present you with a quick 60-second survey. We greatly appreciate your taking the time to complete that survey. Also, time permitting, we'll take a quick look at the results of these polling questions. Now, the third polling question will come also at the tail end of today's webinar, just so folks know. It will come after the Q&A session. I'll leave this out for another 5 seconds, and then we'll get back to James. Looks like most folks have voted. Okay, I'll close that out. And James, part 3.
Thanks, John. Yep, fine. Jumping ahead of myself now. So this is where we get slightly more practical. I think we've been through the theory, we've been through the landscape, and now it's time to kind of jump into the model itself and just use what I've got is the actual model itself, and this is the analytical cycle model, and then go through an example. I've chosen a relatively simple example. It's more to kind of give you a way of applying it than choosing something that's too complicated. But as I use this model more and more, I'm finding more and more applications for it. So hopefully most of the people on this webinar will also take the lead on this and try and apply it to their businesses as well. So it's really a 4-step process, and it's called the lean analytical cycle for a reason. It's a cycle. It goes around in a circle. And you know, the more iterations or cycles that you are able to do, the more information you can gain. So you know, it's not just a one-off process. The first step is figuring out what you want to improve. The second one is creating an experiment. The third one is running the experiment, and the fourth one is measuring the results and deciding what to do. Okay, so figuring out what to improve. Firstly, we need to identify an area of your business that you would like to improve. For example, increase sales in retail, increase in the ASP of the mobile sales. So that's going back to my app that we talked about earlier. Often you'll find that you'll have lots of different areas that you'll want to improve. The best method I found when you want to do that is you always stack rank them in order of importance, and to start with the top one. And if you've got one finished with the top one, you work your way down. Right. The second step is really to understand the assumptions that you've built into those that area of that business that you want to improve. Now, this is probably, you know, one of the critical areas, because there's a lot of assumptions that we make that we don't even think about, but we need to get down and really understand what are the assumptions that are underlying that area that we need to improve, and so that we're able to focus on those. Again, list them in order of importance and start with the top one. So coming back to my very simple example, so the Accessory Shop app, it sells accessories basically for your phone. So you download the app and it chooses accessories for you. We saw in the earlier slide when we looked at the actionable metric that we are dropping in the average revenue per session. So our ASP is dropping, so average selling price is dropping. The other area that I'd like to improve as well is increasing the number of sessions. I've decided to put that as a second improvement, only because that would cost quite a lot of money that I don't have to spend. So what is the hypothesis? The hypothesis is building awareness of other products will increase the ASP. So currently, the way that the app works is that it chooses what phone you have, and it'll choose, it identifies what phone you have, and it chooses accessories for that phone. The idea is that you know, you might want to be buying an accessory for a tablet. So in a session you might buy one accessory for your phone, and then you might buy something for a tablet or something. So that's kind of the hypothesis we're working on. The assumptions that underline that are users don't realize that they can select other products. Users can't navigate back to the selection page, and users want to buy accessories for their device. Now, the third one is at the bottom. It's probably the most important, but it's one that's already been proven in an earlier experiment. So I'm already on my second or third iteration of this. So I'm now looking at another assumption. We're going to focus on the first assumption. Okay, next we need to create the experiment. And there's 4 steps in being able to create an experiment. First, you want to decide on who your target audience is. You might decide, for example, in a sales environment, we also talked about maybe increasing our retail sales. Maybe we want to just choose one chain. So I think one of the key things is to think of analytics in terms of people and the actions. What actions do you want those people to take? And then what group do you want to put those actions on? So be specific about the group we're going to address, and sometimes it's easier to focus on a smaller group than a larger one. This isn't always the case, but in my experience, it's probably easier to focus on a smaller group. The next one is to decide on the experiment. So once you've identified your audiences, really understanding what actions you want them to take, and how many of them are doing it today, and will the experiment have an impact and create change, and how are you going to motivate them. So that's kind of what the experiment is, and then decide on how you will measure it. Again, we need to think actionable metrics here. We don't want to create a vanity metric because that won't tell us anything. So one of the and then, sorry, I'm jumping ahead to the example. And then the final step is probably the most important one. I mean, the other 3 are critical because you can't do the final step before them. But it's really about setting your expectations. You need to set your expectations up front. If you don't set your expectations, what you'll find is that you'll always succeed. So you always have to set a fail level, a pass level, and then the numbers in between require more testing. Let's take our example that we were working on. So in this example, we've decided that our target audience is the high-end mobile device users. We've made the assumption, and this is another assumption that we might want to run another test with, that these people are the people that are going to buy accessories for other products because they probably have a Kindle or an Xbox or an iPad at home. We decide on the experiment. So one of the things that we have in the app is that it automatically chooses the product. So we're going to turn that functionality off and force users to select their own product. And let's see that there's other products that are available. We decide how we will measure it. So we don't necessarily have to focus on the actionable metric that first led us to this experiment, which was the dollars per session. That could be a good use of that. But I've actually decided to go even more granular. I want to measure how many users are actually switching their device. So when they log onto the app, they choose their own phone. How many of them actually switch to another device? And then decide on the results. So currently it's tracking at 4% switch their device. I want to have a look at anything above 5% anything below 5% is a failure, and everything above 15% is a pass. So I want to start getting people to look, explore a lot more products. The third is creating the experiment, or running the experiment, should I say. Here we, the idea of this is, running the experiment that we've already decided. You may want to run more than one experiment at the same time. This will obviously save you time, but you have to make sure that they don't overlap, to avoid overlap that may cause interference, because it would be difficult to identify the actual impact the cause and effect that is being created. You may also want to look at running different experiments at different cohorts, and a cohort is a users with similar characteristics. For example, try one experiment with returning users, so people that are coming back, and a completely different experiment with new users. And then you want to measure the results. And I think one of the key things, and this is what we covered in the last webinar, is accuracy, accessibility, auditability, and actionable, making sure that those metrics are actionable. So having a look at our example. So we ran the experiment for week 39. We measured the results. We saw, as previously said, we were running at a 4% rate, and then we moved up to a 6%. So we've improved 2%. So it's above my failure rate. So we haven't failed. So my hypothesis is probably still true. I just need to do further experiments to see what it is, how I can get people to move between devices. I've checked the data to make sure it's complete and accurate. The data has been made available to the full team. There is a backup available of the detail of the data, so people can go and drill down into the detail, and it's also actionable, so it has a direct impact. So step 4 is measuring the siding. So obviously the experiment, if it's a success, then celebrate a little bit, and then move on to the next assumption, hypothesis, or area of improvement. Like I said at the beginning of the practical session, it's all about iterations, and the more iterations you can do, the more information. But if you only do one iteration, you can only gain a very limited amount of information. If the experiment fails, you went low, then you need to revisit the hypothesis and maybe the assumptions, and maybe look at doing additional experiments or different experiments. And if the experiment moves the needle but not enough to clear the goalpost, you should try the experiment again. So as we hit the 6% mark, which was above our failure rate, but significantly also below the rate at which we wanted to succeed. We go back to our hypothesis, building awareness of the app of other products will increase ASP per session. We also look at those assumptions, and one of the other assumptions is users can't navigate back to the selection page. So that's going to be the next test that I'll be running, improving the ability to navigate back to that product selection page to see if that is the issue that's causing people not to switch products. Now, when you're setting your failure rate and your pass rate, it's important to set it beforehand. But it doesn't mean that once you've set it, it remains static. There is an option to move those, but it's always important to make sure that you're moving them for the right reasons. What you don't want to be doing is moving it just because you want to hit your target. But really trying to understand, is the target that you've set yourself, are they, once you've done the experiment and have got more data, are they realistic, or is there some reason why you could either increase them or decrease them, and really understand that. So it's really about drawing a stake in the ground and then going and retesting and seeing what additional ways you can get to move that metric. So that's just a very, very easy, simple example. I've applied this to many different circumstances and cases, both in, and this comes from a smaller company, but I've also done it in larger companies. I think it's a very simple model. It's forward-looking, so it does give you a lot of information. Down to the last slide. So just a very quick summary. So the lean analytic cycle is metric, hypothesis, experiment, and act. It is a cycle, and the more cycles you can do, the more validated learning you get. So the idea is this isn't just a one-off, you just continue going around and doing more and more learning. The process is forward-looking and therefore more scientific. So that we can see from the ice thought experiment. You must set an upper and lower limit. I think this is very important, otherwise you'll always succeed. So if you set a goal or you create an experiment and you don't set your upper and lower, but you have a great metric, it doesn't mean anything until you've already set your expectation and then see how the experiment performs to that expectation. The process can be applied to any area of business, and most impact is obviously where there's high uncertainty. Where there's low uncertainty and you know the answer, you probably don't need to do this. Lean analytics does not replace strategy process. So it is one of the tools that you should consider to making better decisions faster. So that is pretty much all I had. So let me hand you back to John.
Okay, great. That was really interesting, and we've got a few questions here queued up, but we're going to hop into the Q&A phase now. I would remind folks to go ahead and ask their questions at any time in the question box on the GoToWebinar control panel. So let's get started on some of the questions here. So number one, this is really just a scientific method, isn't it, James?
It is, and I mean, it's quite funny because the first time I actually, I was thinking back, when was the first time I'd ever used this? And it would go back to school. It is just a normal scientific method that you would use in any science experiment that you would do at school, where you set yourself an aim, you do the method. I think one of the important things probably I didn't do is set my expectations. The only difference I'd also highlight is that it's when we did science experiments at school, we normally got a positive result because it was already we already knew the answer, the teacher already knew the answer, so there was a positive result straight away. But when we're doing science experiments in the real world, it's about a lot of iterations, and it's about finding what works and what doesn't work. And this is just a simple way of doing, bringing that into scientific rigor into the business world.
Mm-hmm. Now, your example was not about a financial measure. So are we, I think a lot of folks expect that finance and accounting professionals would be analyzing finance and accounting metrics, debits and credits and numbers on financial statements, et cetera. Are we seeing a trend towards more operational analytics by finance organizations?
Yeah, I think, I've worked in finance for 15 years, and I think, the one interesting thing that I've come across, and this has kind of been highlighted in this whole thinking about lean startup and everything, is revenue isn't necessarily a very good metric. It is, a lot of the time, and I'm not saying all of the time, but a lot of the time it's actually a vanity metric. When we see, when we're measuring, for example, a project or something, and we're looking out into the future and we're trying to measure, how successful that project is, we use revenue, return on investment, and it isn't necessarily a measure that we should always be using. I think we have to be creative in our metrics. What I try to do is also, it's important to be able to keep, revenue and understand all of those metrics, but also look at a lot of additional metrics below those, and operational metrics, and understanding that. When I was working for a retail organization, we were also looking at metrics around unit sales and market share in there. So that is, I guess, slightly an operational metric, but that helped drive that revenue number.
Yeah, not only that, but sorry, just take your example forward. What channel did it come through? What promotions drove particular sales? Yeah, it's funny. I've been in finance for about 20 years myself, and people focus on the top line without thinking of what drove you there. But all of the decisions in a company are around how to drive more revenue. So you need to look at the actionable metrics.
Exactly. And I think the example is that we use the promotions as they were our experiments. So in the retail channel, we isolated specific promotions in certain stores, and we measured the impact on, in that case, it was unit market share against our competitors, and seeing what impact we could have and drive for that. So those ended up as our experiments. and we were able to measure the impact. And once we were able to find out what had a high impact and a low impact, we were able to then take that and put it into a whole lot of other different stores. So instead of just deciding in a room, sitting in a room and deciding on what our marketing strategy was, we did a whole lot of experiments to see what worked and what didn't work in certain channels, and then we were able to extrapolate that across more stores.
Okay, great. Is this analytical framework applicable to the planning process?
That's a very good question. I think,
Sorry, curveball.
I think, and this is where I would have found it very useful in my planning, experience before, is when we are launching new products. And I think, when we're launching new products, the ability to be able to predict, how well a product is going to do, or how well, how we should plan for that product is virtually impossible, given historical things. I'm not suggesting this is always applicable for kind of the runway product. I think, this model applies really well to areas of high uncertainty. If you've got a product that month in, month out produces X amount of units, and you want to forecast that forward, I don't think this model would be necessarily applicable for that. But if you've, in the case that we had to predict products that we're launching that were not even similar to a product that we'd had before. So it would have been really interesting to be able to, and this is some of the stuff, and we're getting into a whole new area here, but creating experiments before the product has been, after it's been conceptualized, but before it's even gone into production or even gone into the design phase and things like that. There are methods, and it's called the concierge MVP. There are methods where you can start to test how well that product is going to do in the marketplace. So there is application there.
Okay. What kind of technology and people do you need to run this sort of ongoing, experiment? It
comes down to the individuals and the companies. I run this in companies from startups where there's 6 people, and we've got very little reporting and very little information. So, the experiments are measured on more qualitative information than quantitative information. And then I've done this in large corporations where we've had huge amounts of data that we're able to pull and use this to build the metrics on. So I think it's more a methodology that can be applied across the board, and as long as you can get your hands on the data and put it into an Excel spreadsheet, you don't need much technology, but you need to work with the teams. Now, for example, if you wanted to do this for, I had another example that I was thinking about that I haven't actually applied, but for example, doing it on, you might not be directly impacting revenue, you might be a cost controller or something. So, this can be applied to something as simple as travel and expenses, where, you might have a hypothesis that if people that are traveling book their tickets 2 weeks in advance, then you'll save a whole lot of money. And your assumptions on that are basically that people that are traveling aren't aware of this, that if you book it 2 weeks early, they can save a lot of money. That's maybe one assumption that you can test. Maybe another assumption that you could test is that people are, too lazy to book it in advance. They aren't good at planning ahead and things like that. So you can start to test those different assumptions that you have, even in a cost environment, so that you're able to really add value to the overall corporation.
Okay. And how do you get your people to make time to do this?
Yeah, I think that's always the critical thing. And when I presented first off, talking about the business case with Google, and the next thing about my overview of what an FP&A function does it's about freeing up that time, automating, simplification, and eliminating. Those are the key things that you have to focus. You have to get your building blocks in place, your historical data building block and the future predictability building block in place, and go through that process. I mean, an easy way of just doing that is what Google did, is just stop producing reports and think what people ask for. But once you've got that time, I mean, the critical thing is to get your team moving up into that higher, into the higher levels, into that more strategic level, and being able to apply that. So, I mean, there's no hard and fast rule to this.
Okay. Are there many companies you know of using this lean methodology for business analytics?
I would say that, it's still very new. There's a lot of companies in Silicon Valley that I come across. As I said, there's a lot of myths about lean. So I think there's a lot of examples out there. I think the one that people use the most is Airbnb. If anybody has read Lean Analytics, the book, they use that example. So there are a lot of companies. Most of them started in the startup world, but there's been a big movement, and it's a bit unfortunate about the name for calling it Lean Startup. But there's in recent times there's been a big movement from startups to large corporates, and I believe that Toyota is probably one of the bigger companies that have adopted this methodology.
Okay. Right, Six Sigma and scientific method, all that, right up their alley. Okay, wonderful. I think that's probably about all the time we have for questions. I see we have a couple of other questions which I will, or we will work with James to get answered offline. My apologies, folks, but we want to get everyone out of here on time, and we've got a couple of other things we want to do before we let everyone go. So first off, just a wee bit of housekeeping. Reminder, you'll be prompted to take a short survey after we close down the event. Please join us at Proformative.com to ask any additional questions. I'm going to see if I can convince James to come online and answer any other questions we have as a continuation of this conversation. And finally, if you have any questions about CPE credits, please send an email to cpe@Proformative.com. Simple enough. We would like to thank again our sponsor, Profix, for enabling us to put on this great event with a wonderful speaker at no cost to our users. So thank you, Profix. Obviously, they're right in the middle of the reporting and analytics world, so this is all near and dear to them, and we greatly appreciate their support. James, great job. It's always nice to be able to kind of come back to basics, and it's funny, in the world of finance, we're so busy reporting and working the debits and credits, sometimes we forget to analyze, or how to analyze, and how to help our companies, enter new markets, improve profitability, operations, et cetera. This is a nice reminder with some very specific examples. So thanks so much for joining us and sharing that information with us.
No, I really appreciate that you inviting me back, and I enjoy giving the webinars, and I hope to all the people out there, this is something that is something that you can take and start to try out. I've tried to condense it down so that it is something that is applicable to any size company.
Wonderful. Well, we do appreciate that. I think you did a great job today. I've gone ahead and launched the final polling question. I'll leave this open for about 30 seconds, and as soon as we're done with that, we'll shut down the webinar, and you'll be presented with that quick 1-minute post-webinar survey, which we appreciate your staying on board for. Thank you for that. I'll go ahead and leave this open for another 10 seconds or so. And with that, I'd like to thank everyone who attended today. We appreciate how busy you are, that you've got lots of options, least of which is not bothering to come to events like this. So thanks so much for choosing a Performative event. We hope to see you again either online at Proformative.com or at another web or live event. And with that, I will go ahead and close down the final poll, and I will close down the webinar. And once again, thank you so much, and I hope you have a great rest of your week, and we'll see you again soon. Cheers, everyone.